What exactly are you looking for this morning?
Yeah, good morning, Dominic. It's going to be a big day for bank earnings, obviously, just the way the calendar works. We've got a lot of big banks coming out today. The headline results, I think, are going to be pretty scary, down, as little as 10% for a name like Bank of America to down close to 50% on headline earnings for Goldman Sachs. So, the important thing to remember here is that really the fundamentals for banks, the lending businesses are doing quite well. We're expecting kind of a mid to high teens growth in net interest income. The enormous swing factors here are going to be loss revisions, which the big four banks with large lending businesses are probably going to reserve about 4.1 trillion this quarter versus a 3.6 trillion reversal last year. So that's an enormous headwind for bank earnings. And then, of course, the capital market sensitive areas, investment banking down 50 to 70%. You have M&A activity that was very soft. Trading probably held up well. So a lot of cross currents this quarter.
Yeah, speaking of cross currents, the conventional wisdom and narrative, the stories that we tell around rising interest rates in banks, or that these rising interest rates are good for them. It helps their net interest margins, their net interest income. They can lend on longer-term bases at higher rates and then kind of keep the shorter end there and kind of turn things around. But that's not the case anymore. The interest rate dynamic is so different right now, and you've got a possible recession coming in the next 6 to 9 months. If you listen to Jamie Dimon, all of that could sap loan demand, right, as people start to kind of get a little bit more inured towards, this idea of higher rates. So how exactly do banks then navigate that kind of environment, and what kind of commentary are they going to put forth today?
So yeah, three items I think to consider there. You hit on a couple of them. The yield curve environment is not as favorable as it could be. We do have higher short-term rates across the board. That's helpful for the prime rate, for example. Banks will benefit from that. But the yield curve being inverted as it is not exactly where you want it. Number two, yes, the higher yields do what they're supposed to, which is pull away from loan growth. So that is a concern moving into 2023, and I think that's where some of this commentary, because loan growth has been so strong. We get, of course, great weekly data from Federal Reserve. It's up 10% year over year in the aggregate. So that will be interesting in terms of commentary, and then loss provisioning. So yeah, higher rates generally universal a tailwind for banks. However, if the economy does weaken, that means more unemployment, and that means higher charge-offs. So there's probably no better correlation in banking than unemployment and charge-offs. If customers lose a job and can't find another one, they're going to default, and that means more charge-offs for banks. So yeah, three dynamics going in there with interest rates.
Stephen, we've got just a few moments left here. I wonder, with that backdrop that you're assuming being set, where is the best place to be in banks right now? Is it the money centers, the investment banks, the regionals?
I think the regionals certainly have it much better. They'll benefit more directly from that lending business boost from that loan growth and net interest margin expansion. They don't have the kind of the dead weight of capital markets right now for the most part. And charge-offs still in pretty good shape, as I mentioned. So I think the regionals are the place to be. We've got another probably a couple of quarters of softness in capital markets as best we can see until that IPO activity turns around, until more liquidity comes into this market. So I think the regionals are the place to be. Names like PNC Financial and Truist, U.S. Bancorp, solid franchises here, good underwriting, good loan growth, and high single-digit to low double-digit PEs, 4% yields. That's a pretty good valuation story.